to our April regulatory brief, where we will talk about all the issues and developments happening in the month of March. I am Stephanie Lyon, SVP of Regulatory and Risk Intelligence at Ncontracts, and I am joined today by two people at the forefront of regulatory change. We have Robert Brosh, our Director of Regulatory Intelligence, and Alesha Briley, our Senior Compliance Expert. March was a packed month, and we'll start with the big industry-wide developments that affect everyone, then zero in on depository institutions. Let's go ahead and get into it, starting with more executive orders coming out of the White House affecting the financial industry sector. Alesha, take it away.
Yeah, and this one definitely impacts the sector, that's for sure, if it comes to fruition. The White House issued an executive order aimed at expanding access to mortgage credit, directing agencies to consider revisiting key parts of the mortgage framework targeted towards smaller banks and community banks. Now, one of the most notable aspects here is how the order defines smaller banks. So for purposes of this order, that threshold is actually set at $100 billion in assets, which is significantly higher than what we typically see under rules like Reg Z for those smaller bank thresholds. So right out of the gate, this isn't just a community bank conversation. This has the potential to reach a much broader group of institutions. And one of the first things that stands out for a compliance audience, I know it did for me, is the enforcement piece. The order directs agencies to consider a policy that discourages civil money penalties except where violations are willful, knowing, or even reckless, with credit given for good corporate conduct and self-correction, and a reasonable opportunity to remediate before enforcement escalates. That points supervision away from find the violation toward did the institution act in good faith and fix the problem? And that has a real implication for how compliance programs document corrective action. Building on that shift, the order also directs agencies to consider replacing TRID's strict timing requirements with a more materially based standard, shifting toward whether a disclosure actually impacted the borrower rather than technical timing precision, which we know is a big piece of TRID. On the origination side, agencies are also directed to consider changes to the ability to repay and qualified mortgage requirements, including the potential for a broader QM safe harbor for portfolio loans and exempting small mortgage loans from QM points and fee caps, or modifying those caps to support affordability. From a data perspective, the order directs the CFPB to consider changes to HMDA, including raising the asset threshold for exemption, including inquiries from scope, and reducing the complexity and the cost of software and training required to report. For those who lived through that 2015, 2018 HMDA revamp, this may feel less like relief and more like retooling, because you're going to have to go back into your processes, your standards, and really rebuild some of that criteria out, depending on how this comes about after the regulatory review. On the digital side, the order calls for eliminating wet signature requirements, standardizing e-signatures and e-notes, expanding remote online notarization, and directing consideration of exempting rate and term and cash out refinances from certain components. This is not an immediate rule change, but it is a clear signal that agencies are being asked to consider rethinking how the mortgage framework is structured, from originations and disclosures to data and reporting and even enforcement. And what we've covered today is really just part of the picture. There is more in this executive order that institutions really should have on their radar. We'll, of course, continue to monitor and provide updates both here in Reg Brief and within NComply.
Thank you, Alesha. We're going to stick around with the executive branch because on March 6th, the White House dropped its national cybersecurity strategy. If you remember back in June of 2025, the administration issued its first cybersecurity executive order that scaled back a lot of those Biden-era compliance mandates while keeping the focus on supply chains and emerging technology. This March strategy takes that same philosophy, but it is organized around 6 pillars, and I'm going to focus on a couple of the key ones. Pillar 1, the administration is basically seeking to incentivize private sector to help identify and disrupt adversary networks. So financial institutions, congratulations, because once again, we are now the de facto partner in national cyber defense, whether you sign up for it or not. The second pillar I want to talk about is all about common sense regulation. The strategy is explicitly moving away from what it calls those costly compliance checklists and instead focusing on streamlined, reduced regulatory burden to give our industry more agility. On a related note, I did notice that the National Cyber Director hinted that the SEC's incident disclosure rule from 2023 may even get revisited. So I think this is correlated with trying to remove some of those regulatory burdens we have seen. Now, before everyone starts popping their Blanc champagne, that's my favorite, about fewer regulations, we are going to have to expect that even if prescriptive rules come down, the expectations are coming up. And what I mean by that is you may remember the FinCEN's sextortion notice from last September. We talked about that. You will note that in this executive order, we're doubling down on calling out the sextortion alongside ransomware and phishing as targets for new interagency action plans. And the proposed victim restoration fund could increase the pressure on financial institutions to identify and freeze any connected funds, right? So basically, you will be expected to be an active participant in disrupting these networks. And the last pillar I want to talk about is about the critical infrastructure of financial institutions, which, by the way, were called out explicitly by name alongside other critical industries. And the call to action was to move away from adversary-linked vendors and secure your supply chain. If you haven't already inventoried your third-party tech stack for foreign origin components, you're going to want to put that at the top of your to-do list. And that's just one of those things that this executive order from the White House and strategic priorities are aligning. So what should you do with the rest of the strategy? I would say 3 things. 1, review your incident response plan and make sure your escalation protocols account for the fact that the government expects faster, deeper public to private coordination. The second thing is, again, take a look at your vendors and supply chain risk management. Make sure you know exactly where your data is going, who's serving you, who might be the beneficial ownership of those vendors. That might be some important information. And 3, pay attention to the strategy's emphasis on preparing for something called quantum computing threats. The short on that version is not an Avengers movie. Quantum computers, when they arrive at scale, will be able to break the encryption that protects most of the data that is moving through the financial systems today. The federal government is basically telling us financial institutions to start planning the transition to encryption methods that can withstand that kind of power. You don't need to do anything right now because it's not happening tomorrow, but you should be asking questions to your IT and maybe even your vendors like, do we have a plan for this when the quantum computers show up? And if the answer you're getting is, what's that? Then that's your cue to take action in informing people of this risk. Robert, I think there was another related update from the White House, right?
That is correct. And I do think it is very related. As Stephanie just talked about cybersecurity, this one deals with artificial intelligence. As financial institutions look to innovate and add new systems and programs and technology, it is important to make sure that as you're doing that your cyber framework is keeping up with everything. But this specific update from the Trump administration was the National Policy Framework for Artificial Intelligence. And for financial institutions, there are a few noteworthy provisions. First, the framework calls on Congress to make federal data sets accessible to the industry in AI-ready formats for use to train AI models and systems. And really, that means the potential for integration of previously non-public data being integrated into technology for financial institutions like underwriting, fraud detection. So definitely something that we are paying attention to. Second, it calls on Congress to avoid making any new federal rulemaking body to regulate artificial intelligence. I think we can all breathe a sigh of relief there. That is good news for a highly regulated industry where we have a whole laundry list of regulators. That is one less that you need to keep track of. And instead, it is going to be your prudential regulators who are more than likely responsible for evaluating your institution's use of artificial intelligence. And then lastly, the federal government has to establish a federal AI policy that is preempting state artificial intelligence laws that impose undue burdens. And so we actually saw that proposed in the budget bill for 2026, and then it was removed, and now it's showing back up here in this policy framework. And in my mind, that means that some of the state laws that we have seen already, such as California's CCPA rules around automated decision-making technology, they are at risk. And so this framework really goes hand in hand with another initiative by the Department of the Treasury, and that is the AI Innovation Series. And it is the government and the private sector planning on meeting to focus on how the US financial system is going to adapt with all of the technological advancement that is occurring. There are going to be 4 roundtables where financial institutions, tech firms, regulators, and experts explore the highest value AI use cases. That way, they can identify approaches to scale innovation and also preserve safety and soundness. None of those have been scheduled yet. Definitely something, again, that we are paying attention to and will notify you all of in Ncomply. And this is just, all on top of the reminder that in February, the Treasury released an artificial intelligence lexicon and also a financial services AI risk management framework. So that way you can stay up to date with all that's happening around AI.
Thank you, Robert. We have been talking about how this administration really isn't about paying attention to the new rules as much as it's paying attention to other signals. And we're going to move on to the other signal, which is our litigation update. And Alesha has a little bit of information of what's happening in the lending space.
That's right. So this one was actually pretty interesting, at least to me. A multi-state coalition of 13 attorneys generals filed suit against a lender alleging a bait and switch scheme involving add-on products, seeking hundreds of millions in restitution, penalties, and injunctive relief, including potential changes to practices, credit reporting impacts, and even loan rescission. At a high level, the complaint focuses on how these add-on products were presented, or in some cases, not clearly presented to consumers. Specifically, the states allege that optional products like credit insurance and membership products were bundled into loan balances at closing, often without clear disclosures that they were optional. Because these products were financed into the loan, it increased both the total loan amount and the interest paid over time. The complaint also points to process concerns, including pressure on employees to include these add-ons, controlling the closing screen, and rushing borrowers through the documents in a way that limited their ability to fully understand what they were agreeing to. From a compliance perspective, this is another example of where regulators, particularly at the state level, are focusing on how products are actually delivered in practice, not just how they're designed on paper. The gap here between written policies and operational execution is a constant theme in cases like this. And none of these themes are necessarily new, but the scale and consistency of the allegations in this complaint are what stand out here. The takeaway is straightforward. Institutions really should ensure that their disclosure practices, their sales processes, and employee incentives are aligned and consistently executed, especially when it comes to add-on products and consumer understanding.
Yeah, I totally agree with those takeaways, Alesha. And we're going to continue on the litigation update where Robert has more on the lending side, where it's really hitting up.
Yeah, a lot of litigation, kind of a red flag or a risk indicator for your institutions that again, federal regulators may be taking a step back, but that doesn't mean that private individuals are not stepping up when they see an issue. So a district court in Ohio did deny a summary judgment motion. So basically, they denied ruling before they had actually gone to trial. And that case involved two financial institutions for alleged RESPA violations. And the financial institutions in this case are the mortgage lender that funded a home loan, and then also a bank that serviced those loans. And so the plaintiff's claim is that the lender wrongfully terminated loan modifications. The plaintiffs say that they attempted to make payment in accordance with the terms of that loan modification, but that payment was refused. And then also those plaintiffs claim that the lender made fraudulent misrepresentations in communications. And two of those were the loan modification that named the servicer as the lender, despite the fact that there had been no assignment transferring the loan, and then also a letter that claimed that the lender was rebranding as the servicer, but allegedly both are separate entities. And so for financial institutions, I think what we keep in mind here is that whether you are funding a loan, whether you're performing as a servicer, maybe you're acting as a sub-servicer of a master servicer, right? When you're blurring those lines on who is responsible for what, that is where things get risky. For borrowers, it needs to be clear who they are required to communicate with about what specific things for their loans. And ultimately, different judicial jurisdictions have differing opinions on whether or not a lender can be held liable for a servicer's mistake. But really, when there isn't a clear distinction in communications with customers, you're only hurting your chances in the unfortunate event that you are brought to court of being successful. And so not only does it cause potential RESPA violations, but not even mentioned in this case, interestingly, is that it can also implicate UDAP for deceptive practices. And so outsourcing servicing, right, it may be common, but if you are doing so, you need to ensure that the borrowers understand what that means for them and that you have third-party monitoring in place to minimize your liability for compliance violations. And so we're just talking about a lot of litigation. For an attorney, that is amazing. So I have another case to talk about, and that is where a federal judge allowed TCPA claims to proceed against a real estate company that sent unsolicited text to purchase a plaintiff's home. And so for traditional financial institutions, your banks, credit unions, mortgage companies, I think this serves as a good reminder of the TCPA exemptions and really being careful with how tricky or how cute you try to get in communications. Exemptions from that prior written consent requirement under TCPA apply to fraud alerts and identity theft notifications, data breach notifications, and transaction and account notifications. And those notifications have to be purely informational, right? If there's any promotional content or sales messaging, then your TCPA requirements apply. And the TCPA also doesn't require an explicit mention of a service if the context of the communication suggests that the caller, your financial institution, is trying to sell services. And so in this case, we had the real estate company. They were offering to buy the home in a hassle-free transaction that they said took the burden off the plaintiff's shoulders. And in reality, the real estate company offered appraisal, title, escrow, and paperwork services that they generally built into the price of purchasing the home. And therefore, the court determined that it was a potential violation of TCPA. And so it can be easy for financial institutions to use those exceptions to solicit additional business, but that is really where you have to be careful. One of the ones that pops into my mind a lot is overdrafts. Maybe your institution sends informational warning texts when a customer is about to overdraft, right? Under the TCPA, that's an exemption and that's okay. But as part of that text, if you're including a line that says something like, we offer you options to ensure that you're able to secure financial independence. We want to make sure that you're able to pay for the things you need. Call us at this number. Now you've potentially suggested overdraft protection as a service. Your institution may receive fees there, and that can be a violation of the TCPA if you haven't already received prior written consent opting into those solicitations. So kind of the takeaway here, occasional audits of your informational communications from a compliance perspective can help prevent those potential issues down the road.
And the other takeaway is don't get cute with communication.
Don't get cute.
All right, let's talk about a settlement now. So we're moving down to the other side of litigation, and now we're talking about a cyber breach. And this one affected a Nebraska family-owned bank, which agreed to pay a $2.4 million settlement to resolve a class action brought by over 200,000 affected individuals. Unfortunately, what happened here is that the bank got caught up in the MOVEit transfer breach. A quick refresher on that MOVEit breach. It happened back in May 2023 when a group of ransomware gang members exploited a vulnerability in this file transfer platform. Over 2,700 organizations were compromised, which accounted to around 93 million individuals' data exposed. The total financial toll has been estimated around $10 billion, so it's pretty bad. And this bank, along many others that got caught up in the same issue, were using MOVEit to transfer files that contain customer data. So you want to think about names, social security numbers, financial details, and the bad actors were able to access those files. And of course, the rest is now litigation history. The class alleged that the bank failed to implement reasonable data security measures. But the bank argued back that the breach was actually caused by the software that the vendor had, their vulnerability, not the bank's. Unfortunately, we have heard that argument before, and we know how it plays out. And in this case, as well as many others, it ended up with a massive settlement against the financial institution. And this is not the only institution that's had to pay a settlement. Comcast, right? They also paid around $117 million in January. So we're likely going to continue to see the impact and the aftermath of the MOVEit transfer breach. And like I said, for me personally, the takeaway here is that courts are consistently holding that your organization that owns the data is ultimately responsible for securing it, even if the vulnerability is in someone else's software or care. So you want to ensure that you are always looking at their ability to manage themselves, that you know exactly which data is passing through. You may want to engage in a fresh risk assessment to ensure you are putting the right vital controls. And the higher the risk, the more important the data, the more you want to be confirming that they have completed patching of known vulnerabilities, which, by the way, seems to be the reoccurring theme in many of these class action data breach lawsuits is people don't patch things they know exist. Second, we want to be reviewing our vendor contracts, and we want to see if they include things like breach notification requirements, indemnification clauses, and cooperation obligations. Because if your vendor agreement wouldn't have helped you in a MOVEit type of scenario, you're going to want to renegotiate if it's possible. Third, and the last one, is to run a tabletop exercise specifically around a vendor compromise. Many of the incident response plans, as we have seen, are written around someone breaking into your network. But what happens when the break-in is at your vendor's network and your data is the collateral damage? That's the scenario you really need to be rehearsing today. Now we're going to move on to issues affecting depository institutions, starting with banks, but I don't want anyone to tune out just yet because both the FDIC and the Federal Reserve just published their annual look at what examiners are citing and what consumers are complaining about. The FDIC did it through its Consumer Compliance Supervisory Highlights, and the Federal Reserve did it through its Consumer Compliance Outlook. Even if you're not supervised by either one of these agencies, you really want to check it out because the same laws apply to banks, credit unions, mortgage company on many of these things. And these are amazingly important compliance risk signals that we all should be watching. So let's start at the top with the big picture, because these trends over the last 3 years really tell a really interesting story. So the FDIC, to start out with, has conducted around 800 exams in 2024. That is down from the 900 that they conducted in 2023. But the violation count, they were still steady at around 1,275. That means that examiners are finding just as many problems with even fewer trips that they have to do to institutions. On the complaint side, both agencies saw a pretty notable surge. The FDIC closed over 26,000 complaints. That's up from 14% from the year before. While the Federal Reserve numbers were even more striking, they investigated around 8,300 complaints. That's an increase of 39% from the prior years. So complaints involving third parties, we're going to want to note that they were increased at the FDIC around 13%. So again, we're going back to third parties not only being a vulnerability for your data, but also potentially violating regulatory obligations and causing consumer harm. And the financial consequences are pretty bad when this happens. The FDIC reported that they assessed $5.6 million in civil monetary penalties, and institutions also had to pay around $33 million in voluntary restitution to affected customers. And that is up from around $7 million that was paid the year before. So a notable increase again. Now, before I run through the top violations, I want to flag something really important about how to read this data, because I was really thinking about it and I'm like, if I think about this, I think it's important for everyone to know that we all know regulators use a risk-based exam approach, meaning we know that they spend most of their time examining regulations that carry the greatest potential harm for consumers, right? So when we see things like TILA, RESPA, and flood insurance at the top of the list year after year, that's partially because those are the areas that the examiners are digging in the hardest. That doesn't mean we're just nailing everything else and we're just doing so good on deposit regulations or privacy laws. It means that everything else is not getting the same level of scrutiny. So that's a problem because examiners may not be paying attention to it, but like we talked about, litigation, private plaintiffs, state banking associations, attorneys, state attorney generals, they may be paying attention to that. So this information we have from the FDIC and the FRB plays double duty. It tells us where our compliance needs to be tight, but it also tells us where examiners are pointing our flashlights, right, when they come into your institution. And for the FDIC, their top 5 violations accounted for nearly 75% of everything they cited. So you need to be paying attention to truth in lending, the Flood Disaster Protection Act, truth in savings, Regulation E, and new in this year's list is HMDA, which replaced Section 5 of the FTC Act. We're talking about UDAP, right? So TILA was the biggest, and the violations were mostly disclosure issues. So back to what we were reporting earlier about, Alesha, I believe you were saying disclosures are so technical and so difficult. Loan estimates, closing disclosures. Did we meet the right timing? Did we provide the right information? Do we have the right periodic statement? All of those are at the top of the list. Secondly, flood insurance is all about those Meyer events. So are you getting the right amount of flood insurance when you're making, increasing, renewing, or extending loans in a special flood hazard area? Clearly, there's some controls you should already have in place that are not working, and systems as well. The Federal Reserve has been beating this same drum about flood, and they even hosted a webinar back in November, and they published a deep dive about the exact same root causes regarding staff not understanding requirements regarding inadequate internal controls and poor monitoring for flood insurance. And flood insurance, we see it in our own enforcement action tracker. It shows up every single time. So let's really make it a year where we pay attention to it and we no longer have to worry about it. Now, here's where the Federal Reserve's complaint data adds an interesting layer. Their number 1 consumer complaint category was restricted or blocked accounts, accounting for around 37% of all complaints. Many of these account blocks and inability to use funds had to do with prepaid cards and mobile banking. And they were especially frozen after your customers reported identity theft or unauthorized use. So think about this. Your customer is doing the right thing by contacting their institution. Now they can't access their wages or government benefits for weeks. That's a massive problem. It's not just a regulatory problem, it's a customer service problem that may make these people leave their institution. So it has a double-edged sword there. Reg E, my favorite regulation to hate, I love saying that because it's so annoying, dominated the violation findings for the federal complaint investigation. Nearly 80% of all violations found through complaints over the last 5 years involved error resolution under Reg E. Both agencies, the FDIC and the FRB, are telling us the same thing, which is if your error resolution process hasn't been updated to account for how customers move money today, think P2P payments, instant transfers, mobile deposits, prepaid accounts, there's a gap that examiners and customers will both find. So the action item is to take a look at both of these publications and do a gap check. Are the violations citing things that you haven't really audited, monitored, or tested before? Or are you on top of that? When is the last time we audited for flood insurance, for example? I would be doing that right now. And are we making sure error resolution procedures are built the way customers transact today? That's the questions your compliance testing and auditing team should be on top of. And the last thing I'll say, it's a little practical, is are your customers able to reach a human being when something goes wrong with their account? The Federal Reserve's data suggests that unresponsive customer service is what's actually driving people to file complaints in the first place. These publications are essentially the exam prep guide, so let's make sure we're using them that way. Now we're going to move on to issues affecting credit unions, where we're on our, 50th round of deregulation, Robert?
I think Alesha's taken that one, but I have covered them in the past. Alesha, what is going on with the deregulation?
Yeah, so deregulation, NCUA, they actually in March issued two of these. So they announced the seventh and eighth round of deregulation proposals as part of its ongoing deregulation project. Which is aimed at reducing unnecessary regulatory burden while maintaining safety and soundness across credit unions. These proposals build on a broader initiative tied to federal deregulatory efforts and reflect the NCUA's continued focus on increasing operational flexibility. And as a reminder, we've covered this earlier phases of this deregulation initiative and probably won't be the last time we cover it in prior reg briefs and future ones. So this is a continuation of that broader effort. In the seventh round, the focus is on records preservation requirements under Part 749. The proposal would streamline record retention expectations by removing prescriptive appendices and allowing more flexibility in how credit unions maintain records, including the use of electronic logs and updated destruction practices. From NCUA's perspective, this is really intended to reduce administrative burden while still ensuring that critical records are maintained and accessible when needed. In the eighth round, the NCUA shifts to lending, specifically looking at requirements around indirect vehicle loans serviced by third parties. The proposal would actually remove existing concentration limits that are currently more prescriptive and instead move toward a principle-based approach. This would allow credit unions to set their own risk-based policies while still remaining subject to supervisory oversight. NCUA's stated goal here is really to provide greater flexibility while still ensuring that the appropriate risk management and governance is assembled. Taken together, these proposals are actually a good example of a broader regulatory trend, moving away from a more detailed prescriptive requirement and toward more principle-based expectations. That shift gives those credit unions a bit more flexibility, but it also places greater responsibility on those credit unions as well in order to define, document, and consistently execute their own policies and controls. So while this may reduce burden on paper, it can increase expectations around governance, oversight, and internal decision making. So the key takeaway here is that flexibility is increasing, but so is the expectation that institutions can demonstrate how they're managing risk within that flexibility. These are still proposals, of course, so nothing's changing immediately, but we'll continue to update and monitor and share developments through future reg briefs and with NComply as well.
Thank you, Alesha, and I hope everyone has an amazing start to your spring. Seems like the theme today is all about personal responsibility. That is what we need to be watching out for, making sure you're targeting the high-risk areas, paying attention to litigation. And for that, you have Ncomply to assist you with all the new regulatory changes, guidance, and litigation news you need. I am Stephanie Lyon, and on behalf of my team, Robert and Alesha, we hope to see you again next time.